I'd like to welcome our new sponsor, Rothschild Capital Solutions. Rothschild is a commercial investment banker and direct lender. The company targets well-located assets for value-add investment, primarily in the Midwest and the Southeast. Rothschild is positioned to invest up to $35 million per deal. They may be just the partner or lender you've been looking for to turn your deals, even the most aspiring, into reality. Need capitalization beyond a debt financing loan? Rothschild gives you a full set of options: JV equity, bridge, preferred equity, mezzanine, development and construction. What do you need? The chances are Rothschild can provide it, as well as the experts to make the deal real. Click on the banner below the show to contact Gary Williams now. You've got the deal, Gary's got the backing you need. Click now. Hello and happy Wednesday, December 9th. Welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going over to the markets today, all three major indices are down on the session. There was a particular hit in the tech stocks as some antitrust sanctions and pursuits are announced in relation to Facebook. There are some exciting IPOs, however, in the tech sector. DoorDash was one that came up coming to market. So some positive news as well. Looking over at the crude oil futures, those are up a little bit from where they were last week. They're now in the $45 barrel range. U.S. 10-year Treasury yields did come down just slightly on their yields. I'd say they're really pretty much range bound, about 93 basis points today on the 10-year yield. Jumping on over to the multifamily interest rates, speaking of range bound, we are still seeing them pretty close to where they were last week. The 223F FHA insured rate is at 231. That is fixed for 35 years. And the 221D4 rate fixed for 40 years, that is quoting at 291. So again, very similar to last week where they were. And jumping over to agencies, also seeing pretty similar to where they were last week. You've got 297 on the Fannie Mae desk on 10-year financing, and you're looking about 342 on the Freddie Mac. That is up a bit, but you got to remember, Freddie Mac needs to quote individually, and they do offer concessions if it's meeting their mission regarding affordability. And of course, there are some green incentives as well. Jumping over to other news, CEO Bank of America came on and was speaking about consumer spending is up. According to their numbers from year-to-date last year into 2020, they are seeing an uptick in consumer spending, which is a positive sign for the economy, of course. A lot of our spending habits have changed, and there's been a drive up in some of that consumer spending, so they're continuing to see that, which is positive. They also mentioned a term called inclusive capitalism, but provided no definition. So again, are these another term that gets thrown out like the ESG around environmental sustainability? I mean, what are we really talking about when we're speaking about inclusive capitalism? That is why I like the definitions that we have in our real estate world, because they really do have much more dialed in definitions. Low-income housing tax credit is a great example of that. We definitely need one for workforce housing, but we've got good definitions for historic, for new market tax credits, qualified census tracts, the list goes on and on. We have very specific definitions around that. I'd like to see corporations that are doing, quasi-philanthropic funding, I'd like to see them define what that means a little bit more clearly, and maybe they have, so we'll have to see what comes out and if there's further updates on that or something that comes out in a future 10K from Bank of America. But I did think that was interesting and worth mentioning. Jumping over to the multifamily markets, one thing of note, I do loans all over the country, lots of times in smaller markets, what are sometimes referred to as tertiary markets, certainly secondary markets. And boy, those cap rates have really gone down from where they were even just a couple of years ago. Looking at deals in smaller markets with cap rates in the low 5% range. I mean, that used to be just unheard of. You'd see in a very small market or tertiary market, in the high 6% range, sometimes even in the low 7% range on cap rates. Now, in these small markets, you're seeing these very low cap rates in the 5% range. Forget about major markets. Those are razor thin, right? In the 4% range, or maybe even lower for some of the major metros, although there's been a bit of a softening in that market. So one thing to think about is, historically, when we see over time interest rates go up, which we haven't seen for quite a while, and certainly nobody's predicting that in the first half of next year, but if we do see those uptick, generally there's a corresponding drop in cap rates, kind of compensates, they counterbalance each other a little bit regarding the purchase price, because your purchasing power goes down, so you've got to account for the pricing of that. But I just don't see much room for these cap rates to get any lower. So that's just something I wanted to mention and put out there as a food for thought. Keep that in mind as you're looking at deals going forward and you're purchasing them if they're at these lower cap rates. Just make sure you've got enough baked in there for your upside. That's definitely going to be important. I see coming out of the pandemic and into whatever kind of recovery you want to call what we're going to have after the vaccine is more widespread. Lastly, I just want to mention COVID escrows. Us lenders, especially secondary market lenders, we wish they'd go away. We don't know at this point when they will go away, but currently they are still in existence, so we do have to talk about them. The HUD program has 9 months, pretty much mandatory, 12 months discretionary, and in some cases for certain affordable housing deals that do not have, let's call it cooperative operating reserve funds that HUD would, equally be able to access in a difficult scenario. So 9 to 12 months, that seems to be sticking for now. Jumping on over to Fannie Mae, we are seeing in the small balance program a reduction that they just announced. They're going to come out with a lesser reserve. They're going from 18 months of principal and interest down to 12 months. So that should help borrowers. Again, it can be a lot of money depending on your transaction, so you have to look at that very closely. Also, you can get an interest-only COVID escrow, so you're not reserving for your principal and your interest, just your interest only. However, that is reserved for the lower leverage loans, which on average would be 65% LTV or lower. That's the typical that you see on those COVID escrows. Loans over $6 million to be determined. We'll see with future guidance what that looks like. We're all excited to see those go away and come back. They are a capital requirement. They do require you to put more money. As long as the property performs, you do get the money back without strings, but it is an upfront cost consideration that you do have to come into your transactions today. If you're pursuing agency or you're pursuing HUD FHA insured, you got to bring that into the forefront of your capital consideration, because it's an additional escrow. You're going to need that money in cash. In one way or another, you're going to have it in cash or letter of credit. So keep that in mind. That is my tip and thought of the week. Thank you all so much for tuning into another exciting edition of Rate Desk. I am your host, Michael Thomas, signing off.